Okay, so this particular session is about free cash flow to the firm. So we will start with some arbitrary data. So let's say I have a firm which has a revenue of $4,500 million. Let's say it earns a contribution margin, which is of 60%, which means the COGS is 40%. COGS stands for cost of goods sold. So if the COGS is 40%, automatically the gross profit implies is 60%. Let's also assume that the operating expenses, excluding depreciation, is 20% or of revenues, and the depreciation is, let's say, $800 million. Depreciation is wear and tear cost. So when you use the assets, there is wear and tear involved. So rather than putting the entire cost of the asset to the P&L in one shot, we spread it over the useful life of the asset. You reduce that, you get EBIT, or in fact, we can first arrive at EBITDA. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. So if you reduce this OPEX, you get EBITDA of $1,800 million, after which we will be reducing the depreciation, which we have assumed works out to be $800 million for the year. Assuming this is a capital intensive firm, you arrive at EBIT. EBIT is earnings before interest and taxes. In this case, it comes to be $1,000 million. Now, assume this firm is assume that this firm is financed by maybe a term loan or bonds of, let's say, $10,000 million, and it carries or either $5,000 million, and it carries 8% annual interest. So we will reduce the interest cost, which is $5,000 million, into an annual obligation of 8%. Reduce that, you will get your PBT, profit before tax, which is 1,000 minus 400, which is $600 million. Assume that the taxes are 40%. So you will arrive at your PAT or net income of $360 million. This is PAT. This is also called as net income in this case because there is no preference dividend, assuming that there are no preference shares to be which have been used to finance the business. Now also assume that the firm has forecasted a capex of $200 million and a working capital investment of $25 million. So if you look at FCFF, FCFF will be net income. You add back the interest into 1 minus tax rate of 40%. Add back the non-cash charges, which is depreciation. Why do we add back depreciation? Because that's a non-cash expense. We have reduced it from the P&L as a notional charge associated with the wear and tear of the asset, but there is no hit on the bank statement as such. So the profit is reduced, but the cash is still there. So we add it back to arrive at the cash flow, right? Why did we add back the interest? Because FCFF is an unlevered cash flow. Unlevered basically means, you would have read by the definition, Unlevered basically means the firm has not got, we are assuming, we are nullifying the impact of leverage of the firm. Leverage means there is no borrowing. So we are nullifying the impact of leverage. तो अगर borrowing नहीं होगा तो interest भी नहीं होगा. Interest नहीं होगा तो you have to add it back. The question is, why are we doing I into 1 minus TR? Because there is a saying in English language, you can't have the cake and eat it too. तो आप ये नहीं बोल सकते कि हम इंटरेस्ट नहीं लेंगे लेकिन उसका टैक्स बेनिफिट लेंगे. Because if you have interest in your P&L, it reduces your profit and therefore reduces your tax liability. तो अगर हम इंटरेस्ट को नलिफाई कर रहे हैं तो हमें उसके बेनिफिट को भी नलिफाई करना पड़ेगा, टैक्स शील्ड को. So that's why we add back I into 1 minus tax rate. And then we reduced any forecasted capital expenditure and the working capital investment. And we arrive at the free cash flow to the firm, which in this case is $1175 million. Now, the formula that I told you is here, net FCFF is equal to net income plus I into 1 minus tax rate plus non-cash charges minus capex minus working capital investment. Right? So this NI plus I into 1 minus TR is nothing but your NOPAT. Now what we will do is we will take two connotations of this. Let us do EBIT into 1 minus tax rate. EBIT into 1 minus tax rate is nothing but net operating profit after taxes. EBIT is operating profit, right? So NOPAT is net operating profit after taxes. That means tax is definitely a cash outflow. So we have to reduce the cash flow to the extent of the anticipated taxes, right? So NOPAT is EBIT into 1 minus tax rate, which is 1000 into 1 minus 40%, which is $600 million. If I do net income plus I into 1 minus tax rate, it will be 360 plus I into 1 minus 40%, which is also the same thing. Which means that EBIT into 1 minus tax rate is the same thing as net income plus I into 1 minus tax rate, which is the same thing as the net operating profit after taxes. Please remember this always, that they are the same things. Okay? This is the same. Please remember that always. Okay? EBIT into 1 minus tax rate is the same thing as net income plus I into 1 minus tax rate is the same thing as NOPAT, which is net operating profit after taxes. And ये जो पहले दो terms है NI plus I into 1 minus TR, this is the one that I was talking about for NOPAT. So essentially free cash flow is nothing but NOPAT, add back the depreciation, which is the non-cash charge, reduce the capex and the working capital investment, because that causes a cash drain on the organization. So that you arrive at FCFF, free cash flow to the firm. When I say firm means you have to consider both the stakeholders, the people who have invested in equity shares also, and the people who have invested in the debt capital bonds also. That's why we are taking it at the EBIT level post taxes, because we want to find out what cash is available to the firm. You understand? Now, how are we going to use this free cash flows? We will forecast the free cash flows for the forecasting period and discount the free cash flows to the present using the appropriate discounting rate. In this case, it will be WACC. WACC stands for weighted average cost of capital. Why? Because we are assuming free cash flow to the firm. So we have to consider the capital which has been invested by the equity shareholders also and the debt capital investors also, because it's to the firm. So both capitals, that's why we are doing it at EBIT level, before payment of interest, before payment of dividends. So we will use WACC to discount the free cash flows to the present, and we will arrive at the valuation of the business within the forecasting period. And for valuation of the business, see, you might, when you are valuing a business, your foresightedness is limited to a certain time period, 5 years, 7 years, 10 years max. But the business does not cease then. The business continues even after that. For that, we have to do the terminal valuation at the end of the forecasting period, which we will use with the same concept of the Gordon's constant growth model. Once we get the terminal valuation at the end of the forecasting period, we will discount it back to the present. So you will have two distinct phases of valuation: value of the business within the forecasting period and value of the business beyond the forecasting period in present value terms. You will then add both of them to arrive at the value of the business. Okay, so that was about free cash flow to the firm and its applicability in the valuation of business.